Good Thursday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How you doing, Dima?
Hey, Will, how's it going?
Buddy? You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. Give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And I'm going to share my screen. While I'm doing that, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it, he'll read back to me. If you would like to come on a show and ask your question live, we also provide a link to Zoom. So click on that link. When you get into Zoom, click on raise your hand. That lets us know you have a question. Once we let you in, you could ask your question live and direct. To give you guys a chance to type in your questions and for more people to join us, we'll take a couple minutes taking a look at the pre-market report, see if we could get insights on what's trading in the pre-market hours, and then we're going to move on to the questions. So pre-market report, these are stocks that are trading in a pre-market hours. I'm going to scroll down here, and we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Here I see 37 stocks made our percentage gainers list, 27 on the decliners. So from that perspective right now, looks like the trading in the pre-market is leaning more towards the bullish side. Let's look at it from another angle. I'm going to come up here, and we have this calendar view, and these are organized by dates. So you could go back in time and see what traded in the pre-market hours back then. Today we're September 28th, and this is the summary of what's going on. So we got 407 stocks trading higher, 238 stocks trading lower in the pre-market hours. As far as volume goes, we got 132.7 million shares trading on up volume versus 74.9 million shares trading on down volume. If we convert the volume to dollar value, not every share is the same price. We got $2.2 billion worth of stock trading higher versus $1.1 billion worth of stock trading lower in the pre-market hours. Let's look at it from one more perspective, and then we'll move on to the questions, Will.
Yeah.
So I'm going to scroll down here. We see we have a list of stocks that contain small cap stocks, ETFs, could be closed-end funds, leverage products, any security that's listed on a major US exchange. If it's trading in pre-market hours and meets our thresholds that we set with liquidity, volume, price, all that, you can make this list. And to narrow down the list to a small group of stocks, we could use the filters above. You have a watch list, you could filter by your watch list. I'm going to use this in ETF filter as an example. And when you click on it, you get a drop-down menu to choose from. I'm going to select SPY, which is the S&P 500 ETF. And when you select that, the list below gets filtered by stocks that are holdings in the SPY ETF. And here we see a little bit of a different picture now. 2 stocks made our percentage gainers list, 7 on the decliners. So from this perspective, looks like there's a slight bearish bias in the pre-market trading. So not much sticks out. Maybe, it's like a mixed bag. I think Amazon's getting sued right now by the FTC for monopoly behavior, or they're claiming that it's a monopoly. So that might be weighing in on the stock. But if we gave it a couple minutes, Will, if you have questions, I'll move on to the questions. We had some residual or leftover questions yesterday. Maybe I'll cover those as well. You want me to do those first?
Yeah, but let's go over the questions from yesterday. No questions have popped up yet.
Okay. So there are two questions. One was on the option block trades screener I wanted to get back to. And another one was, I believe it was the put call parity. It was a question on put call parity.
Yeah.
I mean, I'm sorry, not put call parity. The put call ratio, right? The open put call ratio.
Correct. The put call ratio.
Okay.
And its relevance.
Right. So what do you remember the question exactly?
Yeah, I can read it to you. Let me go to my. It was Jackie. It was, is the put call ratio important to stock and option trading? That was the first part of the question. Second part is, where can I find the ratio on Market Chameleon?
Okay. So I think the question was, is the put call ratio important to stock trading and options trading?
Correct.
Yep. All right. Thank you. So the put call ratio, right? And over here, I'm on the open interest in SPY. It gives you a good breakdown of the open interest. Here's the ratio, 1.8 versus 52-week average. Here's the total open interest in the puts, in the calls. You could see how it changed by, in 1 day, 5 day. You could see the 52-week average. We also have the percentile rank. So there are different ways to measure the open interest in the calls and the puts and compare them against each other. So when we say, is it important? It's a metric that is showing you it's measuring something that you may be interested to research further, right? And what I mean by that, when it's important, it may be important to what you're trying to do or analyze and may not mean anything to you. I'll give you an example, like a PE ratio, right? That's also, it's a ratio. It's a relative value, right? You're comparing the price of the stock to its trailing earnings. And you could have 1,000 PE. Let's say you have 1,000 PE ratio. Well, it's not something that you could just act on because it's 1,000 PE. What it's telling you is that, well, why? The question is, well, that seems unusual. I need to investigate it further. Why is it 1,000 PE, right? Like, why are people paying, 1,000 times its earnings per share? And maybe there's a good reason, and it's kind of leads you down the path of trying to figure out, are people, correct? Because there's, the earnings were bad last year, but they're coming out with a new product, or their earnings growth is going to accelerate, and this is a reasonable valuation given other factors. Or maybe even if you do that evaluation, say, I think it's still too high, and it could lead you to a conclusion, maybe even to a conclusion to take action. But the ratio itself, it's just a measurement. It's a metric pointing something out, right? It's just pointing out, well, here is the state of the, of the economy, or the state of these fundamentals at this point, right? And then if it seems unusual to you, or something like that's like out of line, or then you could go and investigate it further. So if, like, right now, just looking at it, we have a put call ratio of 1.8, on average. If we just compared it to the 52-week average, it's 2, right? And this is in the 25th percentile. So we could even see here that the open interest in the puts is in the 16th percentile, while in the calls, it's 64th percentile. So on a relative basis, right? On a relative basis, it seems like, well, wait a minute, that the amount of puts, right? The open interest in the puts, we could see here 12 million versus the average, versus the open interest in the calls, 7 million over. Seems that less people are committed into the put contracts. So in other words, usually we see more open interest in the puts, less open interest in the calls, even though there are more puts than calls, right? It's not unusual to have more open interest in the puts than the calls. That's just like how normal, typical behavior in the SPY is. There, people use it more for protection than writing calls. And it's slightly, it's gonna, fluctuate around here. It's not like a crazy amount, but it's an indicator, right? It's an indicator where you might have a question. You may have a question, say, well, holy cow, oil prices are hit at the top level. We have a, potentially a government, shutdown, like, they could delay payment for workers, or, we have interest rates going up. And you might have a question, are people panicking about? Are people, buying and holding on to puts more than usual? And you could come here and kind of start that evaluation, where you're like, well, so far things look pretty calm, right? There are less puts than usual, right? We got puts that are open interest 12.4 million versus that's 1 million less than the 52-week average. And if anything, the calls are a little bit higher than the 52-week average. So you could see that. Is it a trade? It doesn't mean you have to go take action. It's just answering some question, right? You're answering a question, and then you could dig deeper into it. Well, maybe the open interest in the puts, maybe there's more meaning to it based on where that open interest is. Is it out further, out in duration? Is it out further on the tail? Where is the open interest concentrated? Is it at the money? Is it the wings? So you could keep digging further, but from a top level, it's just giving you some information, to answer a question that you could go and dig deeper into.
So D,
yeah,
Jackie thankfully is on this morning.
Okay.
And he asks, so the put call ratio is the same as the put call open interest ratio? That's the question.
Well, you could look at, so the put call ratio, right? Usually you're doing it you're looking at the open interest to see how many puts are out there that traded and they're still outstanding versus the calls, right? So you could look at the put call volume, right? So you could look at the volume throughout the trading day, but the volume doesn't always translate to more open interest. So like here, I'll show you down here. Here's the volume yesterday versus the open interest. So you see here, the total volume this is September 20th. Let's do 29th. This one to expire. So September 29th, right? The volume was 2.1 million. The open interest right now is 2.1 million. But on the day from the previous day, right? So if we look at the open interest from the previous day, it increased by 64,000. Right? That's all. It only increased by 64,000, even though 2.1 million contracts traded hands on September 29th, which means that whatever the trading was, it was either people opening and closing positions, or it just happened that there was a transfer of positions from one person to the next, but it didn't increase the open interest by a whole lot relative to what it traded. So here you could see that the volume relative to the open interest, right? The conversion, let's just say how much of this volume converted to an increase in open interest, it was only 3%, right? The volume relative to the change in open interest was 32 times greater. In other words, for every, there were 32 contracts that traded for every one contract that changed the open interest yesterday. And that's why you could look at it from different. You could look at it from the perspective of volume. So we could see here yesterday, there were more puts that traded than calls. 61% of the volume was in the puts versus 39 in the calls. But that doesn't mean all of that volume translated to an increase or decrease in open interest, because a lot of it churns, right? A lot of it is churning. People are using it to day trade or transfer position from one person to the up. So there's a lot of churn. Here, let's take a look at it. Here's the churn. See, so this tells you what percentage on each strike, on each option, actually calls and puts, what percentage of the actual volume converted to new open interest, meaning that whatever traded there, it increased the open interest or decreased it, but it was either building up a position or decreasing a position, and it's still outstanding. It hasn't been closed yet, right? So as of now, it's still out there, right? So if somebody bought puts, they didn't go out and just sell them back out the same day. It actually, they're still on the books, still on their balance sheet. So this shows you the churn by contract, right? So you could have had, this is one contract, but you could have, big volume here. Let's do it by volume. I'm going to sort this by highest volume. So you can see here are the highest contracts by volume, right? So let's say September 29th, because remember, we didn't update yet because it's not 9:30, but you could see here September, 29th expiration relative to the volume, right? The open interest, 91,000 contracts traded, but the open interest increased by 6,600. So there wasn't this huge buildup in position relative to the volume. And you could see that the volume was 13 times greater than the change in open interest, which means that only 7.2% of the volume converted to a change in open interest. So it has a big churn in trading. So when we look at the put call ratio, we're looking at the contracts still outstanding, right? The contracts that are committed that have not yet been either, that haven't expired yet, haven't been exercised, assigned, or closed out. They're still outstanding.
We did get a question asking, does the ratio between buying and selling also matter? Obviously, there's always a buyer and a seller, but I guess it would be the movement of vols, right? If there are more buyers, the vols going up. Probably if there are more sellers, the vols coming in.
Right. So when we look at a trade, right? Every trade has to have a buyer and a seller, or there's no trade. Like two sellers can't match up in trade, and two buyers can't match up in trade. So every trade needs a buyer and seller. So to do a trade in a transaction. But having said that, right, can we get more insights into the trade, right? What we're trying to do is figure out, okay, there are different parties and players in the market space, right? In the whole in a whole landscape, right? There are people who we would call end users, and end users are going in there and trying to, they're trading based on some outlook that they have, right? Based on some opinion, something that they have, and they're using options as an end user to express that opinion, to do a trade, right? You also have professionals there who are liquidity providers, right? They're liquidity providers, and they're not there to specifically, trade on an opinion. They're more there to provide the liquidity, to stand there and buy and sell when other people want to, transfer their risk. And they trade around a theoretical value. So they're willing to buy and sell around the theoretical value. Okay. So when the trade happens, right, what we're trying, we know that the trade happened, we know the price, we know the value, but to dig deeper under the surface, so we could get a little bit more information, we try to figure out, well, what are the end users trying to do, right? How are the end users feeling? Are they equally balanced out? Are they leaning towards one way? Are they acting unusual? Like, what is the behavior of this end user? Because that creates more information for us that could be valuable for those insights, right? Like we could, if, what are they doing? What can we anticipate? How are they behaving? Where are they pushing the prices? So when we look at the trade, let's say, okay, the tape doesn't tell us what the end user's intent is or what they're actually doing. We just see a trade, right? So we just get, here's a trade, here's the quantity, here's the price. But we do have other information out there surrounding circumstances that we could make an inference where we're like, well, this looks like the end users are coming to, buy these calls or sell these calls, or, and that's where we get into the, is there buy pressure, sell pressure? What can we glean from the information to see what are the end users, what are the end users doing and why, and how are they behaving? What are they coming after? And knowing that, could be, extremely valuable to models. Like, market makers, professionals try to model out how end users behave. And a lot of times they could anticipate, how end users in different situations will come into the market and behave as well. So it's a whole study of like the behavior of like end users and what are they doing right now? Are they acting as typical? So sometimes they're just acting, on a daily average. This is how the end user flow looks like. Sometimes you could see anomalies or abnormality, but the idea there is, yes, we know a trade, there's a buyer and a seller, but what are the end users of options that are accessing the market as the customers? What are they trying to do? Right. That's what we're trying to figure out. That's what the order sentiment is doing, right? That's what the order sentiment is trying to take the trades, the surrounding data, and try to figure out what were the end users, when they're trying to access the markets by being aggressive. How were they behaving? What were they trying to do?
Awesome. Super helpful, D. We did have the other question that popped in was Jackie, let me know if there's anything else with that. How does pricing relate to edge on the calls or puts? And that was from Rob. I think that was related to the chart you were showing yesterday.
The chart, do you remember which chart?
Rob's on. Rob, you asked the question, how does the pricing relate to edge on the calls or puts on this
like
chart?
This? The edge, like, so to try to answer this question, the best way I can is when people look at the stock markets, the options markets, and you'll hear this common question say, well, stocks cannot be predicted because they're random, right? Stock prices are random. So if they're random, that means that you cannot predict if the stock is going to go up or down, right? Which is true. However, there are entire mathematical models that deal with randomness, right? So it's not true that you can't deal with randomness. You could still trade it. Like a casino trades randomness, right? A roulette table is random. Okay. a football game is random. You know, the scores that there is lots of things in our economy, society that are random that models deal with, right? And that deals with figuring out the probabilities or the outcomes, the likelihood of something happening. Not is this next stock going to be one? We don't know if it's going to go to 127, right? We don't know if it's going to go to 125. I'm sorry, 425 or 427 or 450 or zero. We don't know this, and the next move is completely random, right? Because we don't know what the news will be. We don't know anything, right? But if we could model the probabilities, right, the likelihoods, and if we could have the probabilities and the payoffs at each level, then we could create a model that's actually workable and tradable. Okay, and you could actually come up with a value for this, you know, or an expected value, and you could come up with a theoretical value based on these models. So, you know, if I have a coin, you know, and I know if it pays exactly 1 to 1, $1, and I know it's 50-50, right? 50-50 chance. Well, it's a break even in statistically speaking, right? Statistically speaking, that's a break even game. But if I figure out or find a coin that's slightly, you know, that skewed somehow, maybe after lots of flips, somehow it got a little bit skewed, and it seems like tails comes out a little bit more often than heads, you know, which is and I could run it through a hypothesis test, and it says like it's statistically significant, right? Well, then there's slight edge, right? That means there's a slightly better expected value betting on tails, even though I don't know if heads will come out or tails, right? Because it's going to be random on every flip. But whatever it is, when the coin hits a certain way, it lands more on tails than heads. Then that's you know, a positive theoretical edge. It's an expected edge. Like when you think of a casino, what is a casino? A casino is based on a statistical edge, right? A casino doesn't forecast. You don't walk into a casino and it forecasts, you know, if the next roulette will be on green or red, or it'll be on this number. They don't even forecast. They don't even care. They let you do that, right? They let you try to figure that out. They just have this statistical edge, but their statistical edge is already set, right? It's a fixed amount. Like anybody could look at it and know the outcomes. It's stationary. It's very easy to calculate. Here, the probabilities are not set. They're not easy to calculate. It's a much harder process with assumptions and estimates. So when we use those probability distributions, we could come up with a theoretical value, right? And again, these theoretical values, they're theoretical because it's based on also these assumptions that we're putting in there, like that the stock behavior in the past will be similar to the stock behavior in the future, and what are the probabilities of it going to here versus there, and we could come up to a theoretical. So we could use that model to come up with a theoretical value for a put, for a call, for a spread, and then we could start comparing that to the market value to see how far away did they diverge, which, you know, can point, again, right now we're pointing to something, right? We're pointing out that, well, why are they diverging so much from a base value, right? Like if we ran this model and got a base, this base model and got this benchmark to compare it to, why is it diverging so much? Is it an opportunity? Am I missing something? Am I not including something in there? Is there news out there that I'm not seeing? You know, that's what it's trying to do. It's pointing you to, well, there's a big divergence here. You know, why is, the next step is, well, why? Why is it diverging so much? Where did I mess up? Am I not, taking something into consideration? Because as a trader, you're the thing that you're usually doing is evaluating and checking and reevaluating before you really commit to something. You have lots of doubts. I think when and the SEC actually did an entire study on this, where they said amateurs or beginners are way overconfident and jump into trades way quicker than a professional would do, right? So a professional would not just jump into trade. They're evaluating, reevaluating, rechecking, trying to put holes into the theories, then they'll test things out of sample. And then when you go and go to live trading, even there you're testing for feedback, because in live trading, you're going to start also learning and discovering things you didn't even understand until you live trade. You're going to start discovering other things where you're like, oh, this is how it works. Oh, this is how the execution is. Oh, this is how the exercise. This is how the so even before you get to live trading, there's a lot of learning. But even on the live trade, your first live trade, your assumption is, I'm going to lose but learn something, right? I'm going to pay to learn something from this trade that will make my trading better going forward.
All right, we're 2 minutes into the open. Awesome job, D. We did have a question, and it pops up occasionally. Do we track the history of the trading cards to the end of the trade? Maybe that's something you can talk about tomorrow. Great job, my friend.
All right, everyone, thank you for joining. Stay safe out there. Have a great trading day.